Listen up, because something critical just happened in the last 48 hours that most people are completely missing. Wall Street's access to XRP just got tested. Hard. 2 days ago, January 29th, XRP ETFs saw their largest outflow since launch. Almost $93 million pulled out in a single day. Grayscale alone lost $98 million. The crypto press screamed crisis. Retail panicked. Price dropped from around $2 to $1.75. Then yesterday, January 30th, XRP ETFs pulled in nearly $17 million. And today, XRP is trading around $1.73, down another percent, testing critical support. But here's what nobody's telling you. This volatility doesn't mean Wall Street access failed. It means it's working. And if you understand why, you're about to position yourself ahead of everyone freaking out. Let me break down what actually happened over the last 3 days. Why institutional money is still flowing into XRP despite the chaos. What this price action reveals about supply dynamics, and what this means for the next 3 months. Because the narrative you're hearing, that Wall Street gave up on XRP, is dead wrong. Wall Street is stress testing the infrastructure, and that infrastructure just proved it can handle both massive redemptions and instant reversals without breaking. The weakness you're seeing today at $1.73, that's the market absorbing institutional rotation. That's price discovery with real liquidity. That's exactly what you want to see before the next major move. Before we dive in, let me be clear about something. If you're trying to understand how institutional capital actually flows during volatility, how ETF mechanics work under pressure, how to read fund flows instead of just price action, you need frameworks retail doesn't have. That's why I built a comprehensive crypto course breaking down institutional strategies, ETF infrastructure, supply dynamics, and portfolio construction that survives chaos. This isn't theory. This is how you make decisions when markets are uncertain. Links in the description. Here's what happened. January 29th, XRP ETFs recorded their largest single-day outflow since Canary Capital launched the first fund in November. Total net outflow, almost $93 million. Grayscale's XRP ETF led redemptions with $98 million leaving, but Canary, Bitwise, and Franklin all saw inflows the same day. Then, yesterday, January 30th, the entire market flipped. XRP ETFs pulled in almost $17 million. 21 shares led with over $8 million. Bitwise added almost $4 million. The panic reversed in 24 hours. Now let's put that in context. Since launch in mid-November, XRP ETFs have accumulated over $1.4 billion in total inflows. Current assets under management, over $1.2 billion. Total XRP locked in ETFs, over 800 million tokens. That's more than 1% of circulating supply structurally removed from markets. The $93 million outflow on the 29th, that's less than 7% of total AUM. It's noise compared to the structural accumulation that's happened since launch. But here's what retail is missing. ETF outflows are healthy. They prove the infrastructure works. When Grayscale saw heavy redemptions, the market absorbed it. ETF shares got redeemed. XRP got returned to circulation or sold into the market. The mechanism functioned exactly as designed. No freezes, no delays, no operational failures. And within a day, new capital came right back in through different funds. That's market efficiency. That's institutional infrastructure operating under stress. Compare that to what we saw with early Bitcoin ETFs. When Grayscale's Bitcoin Trust converted to an ETF, it hemorrhaged billions in the first months. Holders who bought at premium finally had a way to exit. But new ETFs from BlackRock, Fidelity, and others absorbed that selling. The infrastructure handled it. Same thing is happening with XRP. Different funds serve different purposes. Grayscale's fund has higher fees. When alternatives with lower fees exist, capital rotates. That's competition working. Here's the part people miss. Wall Street doesn't need every fund to see inflows every day. They need a system that allows capital to flow where it gets best execution. If Grayscale charges higher fees, institutions move to Franklin or Bitwise. That rotation shows the market is maturing, not failing. And yesterday's reversal, 17 million flowing back in, shows institutional buyers are still deploying capital. They're just being selective about which products they use. Let's talk about what's driving this volatility. 3 things happened in the last week that created selling pressure. First, the Senate Agriculture Committee passed the Clarity Act on a party-line vote with 0 Democratic support. That created uncertainty about whether the bill gets the 60 votes needed in full Senate. Second, Fed Chair Powell took a non-committal stance on rate cuts. Expectations for early 2026 cuts cooled midweek. Third, Bitcoin ETFs saw $500 million in outflows the same day. Risk-off sentiment hit the entire crypto market. But here's what's critical. XRP's outflow was smaller than Bitcoin's in percentage terms, and it reversed faster. Bitcoin funds are still seeing heavy redemptions. XRP funds already flipped back to inflows. That divergence tells you something important about the buyer profile. Bitcoin ETF holders are more sensitive to macro conditions and rate expectations. XRP ETF holders are positioning around infrastructure adoption. Different timeframes, different conviction levels, different behavior. Let me give you the big picture on Wall Street access that everyone's sleeping on. Vanguard opened XRP ETF access to 50 million clients in early December. That was a watershed moment. Vanguard had refused crypto for years. Their CEO had publicly dismissed Bitcoin and crypto as speculation. Then, in one announcement, they opened the floodgates. Not by launching their own crypto products, by allowing third-party ETFs from BlackRock, Fidelity, Bitwise, Franklin on their platform. That's institutional validation at the highest level. And it's not just Vanguard. Fidelity, Schwab, Robinhood, E-Trade, Interactive Brokers, Webull, every major U.S. brokerage platform offers XRP ETFs today. You don't need a crypto wallet. You don't need custody solutions. You don't need compliance frameworks for direct token holdings. You don't need to navigate Coinbase or Kraken or offshore exchanges. You log into your existing brokerage account, search for ticker XRP or XRPC or XRPZ, and click Buy. Same process as buying Apple stock or an S&P 500 fund. That's it. The accessibility is unprecedented in crypto history. Think about what that means for institutional capital that's been locked out of XRP for 7 years. Pension funds with trillion-dollar portfolios, university endowments managing multi-generational wealth, family offices allocating for ultra-high net worth individuals, insurance companies with strict compliance requirements. These entities couldn't touch XRP directly. Risk committees wouldn't approve it. Legal departments wouldn't sign off. Custody was too complex and unregulated. But now? They can allocate through ETFs the same way they buy any regulated security. The operational friction that prevented allocation for nearly a decade is gone. And here's the compounding effect nobody's calculating properly. Vanguard clients don't day trade. They don't chase momentum. They don't panic sell on 5% pullbacks. These are long-term allocators operating on quarterly review cycles. When a Vanguard financial advisor sits down with a client and adds 1% XRP exposure to a $10 million portfolio, that's $100,000. And they don't sell when XRP drops to $1.73. They rebalance by buying more to maintain target allocation. This is sticky capital. This is mandate-driven accumulation that doesn't panic on volatility. It's the exact opposite of retail behavior. And there are 50 million Vanguard clients with access now. Think about that number. Let's do some conservative math on potential demand. Vanguard manages $11 trillion in assets. If just 0.1%, 1/10 of 1%, of eligible assets eventually allocate to crypto ETFs over the next year, that's $11 billion. Now split that conservatively across Bitcoin, Ethereum, Solana, and XRP. Assume XRP gets 20% of crypto allocations because it's newer and institutions are cautious. That's still over $2 billion in potential demand from Vanguard alone. And this isn't one-time flows. This is quarterly rebalancing. This is systematic accumulation over months and years. That's the infrastructure being built right now underneath current price action. Now let me tell you about what's coming that will amplify this infrastructure even more. Derivatives. XRP ETF options markets are likely launching in the second or third quarter based on how Bitcoin and Ethereum ETF timelines played out. Options allow institutions to hedge positions, generate income through covered calls, deploy sophisticated spread strategies. This attracts an entirely different category of market participants: hedge funds, proprietary trading firms, market makers who need derivatives for risk management. They can't participate in spot-only markets efficiently. But once options exist, they deploy capital at scale. And here's the mechanical effect: delta hedging. Market makers who write options have to hedge their exposure by buying or selling the underlying ETF. As more options trade, more hedging flow hits the spot market. That's mechanical demand independent of directional views on XRP. It's structural, it's predictable, and it's powerful. Bitcoin ETF options added rocket fuel to Bitcoin's rally in late 2024. The same mechanism will apply to XRP when options launch. Plus, you'll likely see leveraged and inverse products from ProShares and Direction, 2x and 3x long funds, inverse funds for bears. These are designed for day trading, not long-term holding, but they generate liquidity. They provide price discovery. They create fees for brokers and exchanges, which creates incentives to promote XRP products. Now let's talk about the supply side, because this is where the structural squeeze is happening, and most people don't understand the mathematics. Exchange-held XRP dropped from 4 billion tokens at the start of 2025 to under 1.6 billion today. That's a 57% decline. Over 2.4 billion XRP came off exchanges in 1 year, the largest annual reduction on record. ETFs now hold over 800 million tokens. Combined, that's over 3 billion XRP, nearly 5% of circulating supply, structurally removed from liquid markets. And this number keeps growing every week. Here's why that matters more than people realize. Fewer tokens on exchanges means thinner order books. Thinner order books mean bigger price moves when demand appears. This isn't theory, this is observable market structure. When XRP dropped from $2 to $1.73 over 3 days, you saw huge percentage moves on relatively moderate volume. That's what happens when liquidity is thin. But it cuts both ways. When demand returns, and it will, those same thin order books create explosive upside. 100 million in buy pressure that would have moved price 10% last year might move it 25% now. This is exactly what happened with Bitcoin in 2024. ETFs launched in January. Supply moved into custody over 10 months. Exchange balances plummeted. Bitcoin traded sideways through spring and summer while institutions accumulated. Then, when demand returned in October and November, Bitcoin exploded from 60,000 to over 100,000. That's a 67% move in 2 months, driven by supply scarcity meeting institutional inflows. XRP is following the same playbook 12 months behind. The infrastructure phase is happening now. The supply removal is happening now. The price explosion comes later when these dynamics fully price in. Now let's talk about where we are right now, today, January 31st, and what the current price action is telling us. XRP is trading around $1.73, down from $2 just days ago. That's a 13+% drop in less than a week. Looks brutal. Feels scary if you're retail holding bags. But let me show you what's actually happening underneath the surface, because the story price tells and the story data tells are completely different. First, volume. XRP's 24-hour trading volume is sitting around $4 billion. That's down from the 8 to 10 billion we saw during peak volatility earlier in January. Lower volume during consolidation and pullbacks is normal. It means fewer participants are panic selling. The weak hands already exited. What you want to see is volume expansion when price breaks key levels, either to the upside or downside. That tells you new participants are entering. Low volume during sideways or down moves? That's just existing holders repositioning. Nothing alarming. Second, support levels. 1.70 is critical. That's been tested multiple times over the past month. If XRP holds above that level and bounces, it confirms institutional buying interest remains intact. Below 170, next support is around 1.60 to 1.65. That would represent roughly a 10% drop from current levels. Still not catastrophic in crypto terms. Still well above the lows we saw in late 2024 when XRP was trading below $1.50. The floor is structurally higher now because the infrastructure, ETFs, legal clarity, institutional access, didn't exist in previous cycles. Third, resistance levels. $2 is the first major hurdle. XRP tested it multiple times in January and got rejected each time. That's where profit takers sit. That's where traders who bought lower lock in gains. Breaking above $2 with conviction and holding it for several days would signal the consolidation phase is over and the next leg up is starting. Beyond that, 220 and 250 become targets. 250 is psychologically significant and aligns with technical resistance from December highs. Fourth, moving averages. XRP is currently below its 50-day moving average, which is a short-term bearish signal. But it's above its 200-day moving average, which is a long-term bullish signal. This divergence is classic consolidation behavior. Short-term weakness, long-term strength. The 50-day MA is trending up, which means momentum is building even if price hasn't broken out yet. When the 50-day crosses above the 200-day, called the golden cross, that's typically a strong bullish signal that precedes major moves. We're not there yet, but we're setting up for it. Fifth, Relative strength. Compare XRP to Bitcoin and Ethereum over the last week. Bitcoin is down, Ethereum is down, XRP is down, but XRP's decline is roughly in line with the broader market, not dramatically worse. That tells you this isn't XRP-specific weakness. This is risk-off across crypto. And when risk-on sentiment returns, which it will when macro conditions improve, XRP will likely benefit alongside everything else. The key is that XRP hasn't decoupled to the downside. It's tracking the market. That's what you want to see. Now let me tell you what smart money is doing at these levels, because it's the exact opposite of what retail is doing. Retail sees $1.73 and thinks, it's going lower, I should sell or wait. Institutions see $1.73 after XRP tested over $3.50 in July and think, this is a 50+% discount from all-time highs with fundamentals that are stronger than they were at the peak. Which perspective makes more sense? In July, when XRP hit 366, there were no ETFs. Vanguard hadn't opened access. RLUSD was barely launched. RippleNet was processing less volume. Ripple didn't have OCC approval or a pending Fed master account application. The infrastructure was weaker, yet price was higher. Today, the infrastructure is stronger and price is 50% lower. That's called opportunity. And the data shows strong hands are accumulating. Wallets holding over 1 billion XRP have been steadily adding since early January when the correction started. Their holdings increased from over 23 billion to over 23.5 billion. That's whale accumulation during weakness. That's smart money positioning. Unlike last year, when mega whales waited until late February to buy, they're building positions earlier this cycle. That reduces the probability of deep collapse even if short-term chop continues. Let's address what happened with Grayscale specifically, because understanding this matters. Grayscale's XRP ETF launched with 0.35% fees after a 3-month waiver period. That's higher than competitors. Bitwise charges 0.3%, Franklin charges 0.3%, 21 Shares charges 0.3%. When you're an institutional allocator deploying millions, those fee differences matter. 5 basis points on a $100 million allocation is $50,000 annually. So capital rotates to lower-cost products. Grayscale's redemptions don't mean institutions are leaving XRP. They mean institutions are leaving Grayscale's fund for cheaper alternatives. And the proof is in yesterday's flows. While Grayscale lost $98 million on the 29th, Canary, Bitwise, and Franklin saw inflows. Then, on the 30th, 21 Shares pulled in over $8 million, and Bitwise added almost $4 million. The capital didn't leave the XRP ETF ecosystem. It just moved to better products. That's market efficiency. Now let me talk about what's not being reported. The longer-term structural tailwinds that make Wall Street access to XRP inevitable. First, Ripple received conditional OCC approval in December for Ripple National Trust Bank. They've applied for a Federal Reserve master account. If approved, Ripple can hold RLUSD reserves directly at the Fed. That's unprecedented legitimacy. Banks will adopt RLUSD knowing it's backed by a federally chartered institution with Fed access. That drives XRP demand for liquidity bridging. This is independent of ETF flows. This is utility-driven adoption. Second, XRPL transaction volume hit 50 million in January, approaching 2 million daily. That's up significantly from 30 to 40 million monthly in late 2024. Growing transactions mean growing utility, more developers building, more liquidity pools, more DeFi applications, more payment corridors. Transaction volume is a leading indicator of network value, and it's trending up even while price consolidates. That tells you real adoption is scaling regardless of short-term volatility. Third, active wallets on XRPL exceeded 5.2 million in January. That's up from 4 million in late 2023. More wallets means broader adoption. More users, more use cases, more geographies. Network effects matter in crypto. The more participants, the more valuable the network becomes. XRPL's user base is expanding, not contracting. That's bullish for long-term value regardless of two-day ETF volatility. Let me give you the contrarian take on why the last 2 days might actually be good for XRP long-term. Markets need volatility to price assets correctly. If XRP ETFs only saw inflows every single day with 0 redemptions, that would signal retail FOMO, not institutional conviction. Institutions want the ability to reduce positions when conditions change. That optionality is why they use ETFs instead of holding tokens directly. So when Grayscale sees 98 million in redemptions and the system handles it smoothly, that proves the infrastructure works. That builds confidence for the next wave of allocators. And here's the psychological dynamic playing out. Retail panics on outflows. Institutions see opportunity. When funds show net redemptions, headlines scream crisis. Retail sells, price drops, and institutions step in at lower levels. That's why yesterday's 17 million inflow happened so fast. Smart money doesn't wait for confirmation. They position during fear. And the infrastructure that lets them deploy capital seamlessly, that's what Wall Street Access provides. Click, buy, done. No wallets, no exchanges, no friction. Let's talk about what analysts are projecting based on this ETF infrastructure. Standard Chartered maintains their $8 year-end target. That's over 300% upside from current levels around $2. Their thesis? ETF adoption creates sustained institutional inflows that overwhelm available supply. RippleNet and RLUSD adoption scale utility-driven demand. Regulatory clarity through Clarity Act or other pathways removes remaining institutional barriers. If those three factors align, XRP targets $4 to $5 by mid-year and potentially $8 by year-end. More conservative analysts cluster around $3 to $4 base case. The argument? ETF flows stay positive but moderate. RLUSD grows but doesn't explode. Macro conditions stay neutral without major rate cuts or risk-on catalysts. Under that scenario, XRP consolidates between $2 and $3 through most of the year, then breaks out in Q4 when regulatory clarity improves and institutional mandates compound. That's still a 50 to 100% gain from current levels. Not moonshot territory, but solid institutional returns. Here's what to watch over the next 30 days to gauge whether institutional access is accelerating or stalling. First, weekly ETF flow patterns. If inflows stay consistently above 50 million weekly, institutional conviction is intact and building. If we see multiple consecutive weeks of net outflows exceeding 50 million, that signals mandate-driven buying has paused, and we might consolidate longer. 2. Fee competition among issuers. Watch for fee cuts from Grayscale or other high-fee funds trying to stop redemptions. Lower fees accelerate capital rotation and grow total AUM faster. 3. New ETF filings. If BlackRock files for an XRP ETF, which they haven't yet, that's a massive credibility shock that pulls conservative capital into the space. 4. Vanguard-specific flow data if it becomes trackable. We want confirmation that the December access announcement actually translated into real allocations from Vanguard's 50 million clients. 5. Exchange balance trends continuing lower. If XRP on exchanges drops below 1.4 billion, then 1.2 billion, the supply squeeze intensifies dramatically. 6. Whale wallet accumulation patterns. Those 2,700 wallets holding over 1 million XRP are at all-time highs. If that number keeps growing through current weakness, institutions are positioning aggressively. 7. RLUSD market cap milestones. Crossing 2 billion, 3 billion, or 5 billion in market cap proves utility is scaling regardless of short-term price action. Let me address the elephant in the room. What if ETF outflows accelerate? What if the last 2 days are the start of a trend instead of a blip? Here's the reality check. Total XRP ETF AUM is over 1.2 billion. If 10% redeems over coming weeks, that's 120 million. That XRP gets returned to circulation or sold. Price probably tests support around 1.70 or 1.60. But does that break the thesis? No, because the infrastructure still exists. The accessibility still exists. And when conditions improve, whether that's Clarity Act passage, Fed rate cuts, macro risk on, or RLUSD adoption milestones, capital flows right back in. The difference between now and previous cycles is that Wall Street infrastructure didn't exist before. If you wanted XRP exposure in 2020 or 2022, you needed Coinbase or Kraken accounts. You needed wallets. You needed to navigate compliance. Most institutions just said no. Now, ETFs remove all that friction. So even if we see temporary redemptions, the pathway for capital to return is easier than ever. That's the structural change. That's why the last 2 days don't scare long-term holders. Here's the tactical playbook based on your time frame and risk tolerance. If you're long-term bullish on XRP fundamentals and believe in the institutional adoption thesis, use current weakness to accumulate positions. XRP at $1.73 after testing over $3.50 in July represents a major discount. Dollar cost average over the next several weeks. Don't try timing exact bottoms. Build positions systematically as price consolidates in this range. If you're a swing trader watching technical levels, 170 support is your line in the sand. If it holds and bounces with volume expansion, that's your entry signal for a trade back toward $2 or $2.20. Set stop losses below 165. If price breaks 170 decisively on high volume, wait for next support around 160 before re-entering. Don't over-leverage during uncertain periods. If you're risk-averse or uncertain about near-term direction, there's zero shame in waiting for confirmation. When weekly ETF flows stabilize consistently above 50 million and price breaks decisively above 220 with volume, that confirms the thesis and you enter with less uncertainty. Missing a 20% move because you waited is far better than losing 40% because you allocated too early. Let me give you the bull case in its strongest form. Wall Street access to XRP is now seamless. Over $1.4 billion has flowed into ETFs in less than 3 months. Vanguard opened access to 50 million clients. Exchange balances are at 7-year lows. Over 3 billion XRP structurally removed from circulation. RLUSD scaling with BlackRock and MasterCard. Ripple net processing over 1 trillion annually. Ripple applying for Fed Master account. XRPL transactions and active wallets both surging. The Clarity Act progressing through Senate committees despite partisan friction. If the bill passes this year, XRP targets $4 to $5 as regulatory certainty gets priced in. If the bill fails but Ripple gets Fed approval and RLUSD scales to 5 billion, XRP still targets $3 to $4 on utility. If both catalysts hit, $8 becomes realistic. The infrastructure exists, the adoption is scaling, the institutional access is built. The last 2 days of volatility? That's noise. The signal is Wall Street can buy XRP easier than ever, and they are buying, just selectively, just intelligently, just like institutions should. If you want frameworks for reading ETF flows, understanding institutional behavior during volatility, interpreting supply dynamics, and building positions that survive chaos, check out the crypto course I've built. We break down real-world scenarios like the last 2 days, teach you how to separate signal from noise, and give you decision-making tools that work when markets are uncertain. This isn't about predicting the future. It's about positioning intelligently regardless of which scenario plays out. Links in the description. All right, let's wrap this up. Yesterday, XRP ETFs saw 93 million in outflows, largest since launch. Grayscale lost 98 million. Crypto press screamed crisis. Today, XRP ETFs pulled in 17 million. The panic reversed in 24 hours. What does that tell you? The infrastructure works. Wall Street access isn't failing. It's being stress tested, and it's passing. Institutions can enter. Institutions can exit. Capital can rotate between funds. The mechanism operates smoothly under pressure. Total XRP ETF AUM, over 1.2 billion. Total XRP locked, over 800 million tokens. Exchange balances, 7-year lows. Whale accumulation, ongoing. XRPL transactions, surging. RLUSD, scaling. The fundamentals haven't changed. The Clarity Act is progressing. Ripple is applying for Fed access. Wall Street has seamless entry points through Vanguard, Fidelity, Schwab, every major platform. The last 2 days weren't failure, they were price discovery. They were the market figuring out what XRP is worth with institutional access. And that process is just beginning. Stay ready, stay liquid.